Real estate is hitting a 2-year high today, though it's lagged the broader market in terms of performance this year. With the Fed broadly expected to start cutting next month, my next guest says REITs will benefit, and in more ways than one. Back on set with me with her names to buy is Laurel Durkay. She's head of global listed real assets at Morgan Stanley Investment Management. Welcome to you.
Thank you.
Is it, I always feel like people are a little late, when we finally all go, yes, the Fed's going to cut, let's get out, the shopping list. But is the move already made?
I don't think so. If you look at the performance of real estate securities, really over the past 5 years, there's been almost a 10% annual underperformance of REITs versus the broader market.
That's a lot.
Yeah, but if you look at the prior 15 years, REITs actually were very competitive with the market and outperformed by about 50 basis points.
It must have been very small back then, though, presumably as a...
Well, they've been growing.
Yeah.
They have been growing as a sector over time. But I think there's this sort of negative recency bias against REITs. But what we're seeing today is obviously what you were just talking about. The rate cuts are coming. And there's historical precedent to show that REITs do outperform the broader market 1 year following a rate cut.
Okay. So does it, I know on some level it matters if we're going into recession. I'm sure in that case, rent payments and everything gets thrown into whack. And so I guess this is to some extent predicated on an economy that continues growing, supports these payments, and so on and so forth.
Well, I think that there are actually a very necessity-based nature of the demand for real estate. And so you do see a lot of sectors within the overall real estate world that do tend to be more recession resilient or recession resistant than one may think. Of course, there's going to be some sectors that obviously will experience weaker growth. But what I have really focused on, even starting at the beginning of the year, were those sectors that were really had fundamental underpinnings of demand that were more secular in nature, as opposed to
like
tied to the
healthcare, I would imagine, has to be one.
Exactly. So aging demographics are a trend that's really benefiting healthcare. You see AI and technology really benefiting the data center sector. You see the housing affordability really benefiting rental housing in the U.S.
Like single-family homes to rent, that sort of thing. So those are we're showing some of your top picks. Agree, is it VICI, VICI, and so forth? And those have those characteristics? No.
So what I'm most excited about today, actually, are the REITs that are going to directly benefit from the rate cuts that we're seeing. And so when I think about who is going to benefit the most from rate cuts, it's really those companies that are going to experience a better weighted average cost of capital and therefore be able to invest in properties at a higher spread.
Absolutely.
And get better accretion and really directly influence that cash flow growth for these companies. So I'm looking at net lease companies. These are long-term, 20-year leases that have a very stable internal core, but the kicker to growth comes from that external, that acquisition. And so if you look at Agree, if you look at Vici, if you look at Care Trust, these are net lease companies that operate within retail, gaming, and healthcare that are going to really experience that improved acquisition spread and therefore be able to really have a better cash flow growth as a direct result of rate cuts.
You were surprised when I said REITs make my head hurt. And then you go get talking about net lease, something, and I'm going, I think I'm tracking with you. So what you're describing, though, also is one reason why these stocks are often viewed as a little, I don't want to say dangerous, combustible, but they have a lot of these leverage aspects to them that you kind of have to get things going in the right direction for them to really be powerful. Is there anything in what you've described that could kind of happen and all of a sudden make this trade, which seems like a sure thing, a little bit less so?
Well, we also have valuation support for real estate securities. If you look at where they're trading today, they're about 4 to 5 turns cheap on a multiple basis versus the broader market. If you look at all of the individual GIC sectors, only energy sector stocks are more divergent from the historical spread than where REITs stand today.
More hated, one might say. Yeah.
One may say that. I don't like to say that.
I'm sure you wouldn't.
But that would imply 30 to 40% upside relative to the S&P for REITs.